It's been a while, so I thought it was time for a watch market update. What's good, what's bad, and what does it mean for people like us that just want to spend unreasonable amounts of money on pointless bracelets that tell time much less accurately than any phone can? We're talking about the market in general, the grey market, LVMH, Richemont, Swatch, and their performance in the last year. Let's dive in. For those of you that have a healthy association with watch collecting and those of you that live under a rock, this recap is for you. In and around 2020, prices went bananas. COVID, crypto, and a whole lot of other things happened that massively drove up prices on pretty much all watches. Rolex Daytonas that had always been popular were selling for 3 or 4 or sometimes 5 times above retail. And watches like the Laureato from Girard-Perregaux, which is a good watch, but has never been a particularly desirable watch, were also being sold above retail. Things peaked around mid-2022. Since then, prices have consistently been coming down. At first, they dropped quite dramatically. Since mid-2023, though, the decline has continued, but nowhere near as rapidly as it did from 2022 to 2023. The decline was driven by a decline in crypto bro liquidity, rapid inflation post-COVID, a cooling of the job market, a slowdown of the Chinese economy, and a whole lot of other factors. Now, I don't want any decline. I'd like to expand my little YouTube community. So for those of you that haven't subscribed, if you enjoy my content and think it's worth your time, then click the subscribe button below. It's hugely appreciated. Thanks. So where are we today? LVMH, who are the conglomerate that hold, among others, Zenith, TAG, Hublot, declined in overall sales in 2024 by 3%. Richemont, who hold, among others, Jaeger-LeCoultre, also declined by 3% and posted a 15.1% profit margin on their watch division. Swatch Group didn't at the time of the video have a full year report, but they were, in terms of volumes, 12% lower than the previous period, depending on how you factor in exchange rates. Those are the big companies where we have the facts. We don't have a lot of hard data on brands like Rolex, AP, and Patek, so we can't conclude anything definitively about them. But the Morgan Stanley report showed that out of 50 brands, 38 of them dropped and 12 increased, of which Rolex and AP were ones that increased. My guess is that Rolex have been basically insulated to some extent from a decline because they are priced high in the high end and they are already, they were already way behind in terms of delivering on demand. So a slowdown in demand in the market coupled with them only slowly picking up output has probably meant that they haven't been impacted negatively that much, which the Morgan Stanley report also seems to indicate. I think for Rolex, there was this queue outside the store for people that was so long they couldn't get a watch that even though some of those people dropped out, the queue was still there. When their production started to catch up, they probably didn't feel the drop-off in real sales. For the brands that don't have queues, so the Omegas of this world, we maybe have a queue for the Omega, Speedmaster, and White, but in general don't have queues for all their watches, I think they probably had stores packed with extra stock and then they got hit by the AD saying, you know what, we don't need a refill for 2024. We've still got stuff left from the previous shipment, so don't worry about sending us any new stuff anytime soon. And that's what shows the drop-off in the numbers in the Morgan Stanley reports. Looking at the market overall, the secondary market is a good indicator of what is going on. Rolex is becoming more and more available. Sure, it's still impossible to get a Daytona without a long waiting period, but the grey dealers will tell you that a lot of two-tone and full gold models are available from them below retail. This is, of course, going to depend a lot on where you are in the world, but the overall picture is just that. Datejusts and OPs are also starting to become available. Go to Omega and pretty much everything is ready to buy except still, for the white Omega Speedy and maybe 1 or 2 of those specialty models and models which are intentionally limited in production numbers. Overall, I'm hearing more and more stories about dealers offering discounts on certain models, and inventory on sites like Chrono24 does indicate that a lot of stock is out there and it's available below retail. A Nautilus is still hard to come by, as is a Reverso Duophase Chrono, but if you want a Polaris or an Ingenieur or a Seamaster, those are just walk-ins. When I go through the recent Morgan Stanley report, the picture is basically the same. A few independents like Rolex, AP, Patek have continued to do well, where pretty much any brand from Richemont, LVMH or Swatch have declined. Even Tudor declined. And I've been back and forth on Tudor. I think I've said quite a few times that Tudor was entering this boring phase where releases would be less exciting. Additionally, I've also said that it was inevitable at some point that someone else would take over the hype spot from Tudor. Based on the Morgan Stanley numbers, I think there's a reasonable argument to be made that Tudor is no longer the hype brand. I know the Flamingo Not Pink is selling for $20,000, but I think it's aberration. The numbers in their Morgan Stanley numbers are overall dropping. I know the numbers in the report indicate a massive drop from an estimated 255 in 2023 and 160 in 2024. And I think in 2022 it was 65,000. So it sounds catastrophic, but I think you need to take those numbers with a little bit of grain of salt. You have to remember that Morgan Stanley look at what brands are selling and not what customers are buying. There's an in-between, which is wholesalers and ADs. A huge drop like that can just indicate that a lot of watches got shipped the year before to dealers, and now demand is low at the dealer level, and there's a lot of inventory at the store level, so the orders coming in to Tudor are lower. Longines dropped from 1.6 million to 950,000. Now, is there that much less demand for Tudor and Longines and other brands? I wouldn't interpret it as if half their customer base just disappeared, but I do think the Tudor Black Bay craze is over. Tudor has been the most hyped brand for 5-10 years. They were also hyped in the period where the watch market in general was super hyped. So it stands to reason that they are the ones that are getting hit a little bit harder. But I don't think it's reasonable to assume that half of their potential customers just disappeared from one year to the next. The hype, though, is over, I think, despite the attempts with the Tudor Flamingo Pink and Flamingo Not Pink to remain daring and relevant and exciting. Generally, the number I care a little bit more about in the Morgan Stanley report is the implied retail price. In a world where everybody babbles on about premiumization, I care about whether a brand succeeds in getting the average price of their watches up in an overall declining market. Rolex, Omega, AP, Patek, Glosswood Original among those that succeeded, but IWC, JLC, Tudor, none of them did. Now think about that for a second. JLC have increased prices massively, but they sold fewer watches, and the implied average price of each watch is largely unchanged. It's the expensive stuff that's sitting on the shelf, and that's not good. Why the slowdown? I mean, apart from the 2022 bubble bursting. Well, it's a couple of things. Watches just aren't as cool as they have been. I know, it's insane, right? If you're here, that statement makes no sense to you, but it's true. COVID and that period of time was an anomaly. It was literally a period where people were bored out of their minds. They had cash to spend and they spent it on watches. Most of those people are gone now. The crypto bros are mostly gone. The regular people that wanted a Submariner either have one now or have lost interest. The overall global excitement, which was completely unprecedented, is gone. It was a blip. It was an anomaly. This is just a curious note, but there's a grey market retailer that I follow very closely on their site. And 3 years back, they had links on information on how you turn a watch into an investment. I still have screenshots of it, but the text is gone now and nowhere to be found. Instead, now they're demanding cash up front for certain purchases, partly because of money laundering reasons, but also just simply because of liquidity reasons. The point is, things are largely back to normal in terms of demand, and grey market dealers talking about investments are things of the past. Second, it's China. LVMH, Richemont, and Swatch all mention low demand in China as a massive challenge. The Europe and US, the Middle East, are all doing okay. Some of them even increased, but Chinese demand for luxury watches has almost collapsed. In October 2024, the exports to China were down 47% compared to the same period of the year before. China was for a long time this massively growing economy with tons of middle-class people that were screaming for foreign status goods that they could flaunt. These days, I don't see as many Chinese tourists in our local stores. There are fewer Chinese-speaking staff at the ADs simply because there aren't as many Chinese people traveling. They're there, but considering the size of their economy, their absence is notable. So despite the US and parts of Europe showing decent demand, it just can't compensate for the relative absence of Chinese customers. Before we look at the outlook, I think it's important to state that whether you look at the data from sites like Chrono24, Watch Charts, Deloitte, or Morgan Stanley, you will see the same picture. Prices year on year are still higher today than they were 5 years ago. The overall market in terms of revenues is still strong, and watch prices on average are still higher now than they were 5, 10, or 20 years ago. I'm not an economist, but if I had to choose between a scenario where in the short to medium term the US picks up steam in terms of the economy, or it goes downhill in terms of the economy, my personal gut feeling is it's more likely to go downhill than improve. I expect that brands are likely not going to be as aggressive on price increases in the coming years simply because current demand doesn't signal a desire from customers to pay even more. Rolex price increases this year have basically been quite modest and have more or less just been adjustments to material price increases. So steel barely increased while gold has gotten 25 to 30% more expensive, but they raised the prices only by 15%. You never know with brands like Jaeger-LeCoultre. I still think they are trying to convince themselves that they are customers for $10,000 entry-level reversos, but in general, a wise CEO is not massively raising prices right now. In the lower end, Donald Trump flip-flopped on Chinese tariffs a few weeks ago, and things likely have changed once this video has come out. But I predicted in a video some months back that Trump would cut the loophole for cheap imports from China, which he did, and then he changed his mind. That would have made cheap Chinese watch imports to the US more expensive, but my money is this loophole will still end up being closed at some point. I also think it will be the case in Europe, as they too are getting tired of Temu, Alibaba, and AliExpress imports, not just watches, pretty much everything. As for China, I don't see demand picking up. There's a looming trade war in its infancy. How that plays out is beyond my pay grade, but I do know this much. When things are uncertain, people don't go out and buy wrist trinkets. It's when you're not afraid of losing your job that you splurge on a Rolex or a Tudor or a Hublot. The same goes for the rest of the world. Again, economists far smarter than me do not agree what will be the long-term outcome of Trump and tariffs and potential trade wars. We don't know from day to day what will actually be implemented, but I again do know that people don't buy Rolexes when they're insecure about the future. Big tech is also laying off people big time. The American federal government seems to be cut to the bone in terms of staff. And I don't see people buying a new watch to celebrate their new unemployment. Basically, what I'm saying is that I have a hard time seeing any scenario where 2025 is going to be a year where we see a massive uptick in demand, a massive uptick in pricing. Rolex is going to become even more available and discounts are going to be more prevalent for other brands on average. If you're not one of those people worried about whether you're going to be laid off or worried about a trade war and how it's going to make things unaffordable, then honestly, this is probably a good watch buying period for you. Because right now, weirdly, in the watch world, things are normal. You can get most non-limited, non-special edition watches from most brands. If you ask nicely at the AD, they might even get you a discount, and the grey dealers are also willing to negotiate. Their stock isn't moving that fast either. And if they have a Seamaster chronograph lying around for some reason, I'm willing to bet that they're open to discussing the price with you. So that's likely not a bad thing. I'd personally prefer some more predictability and security in the world, but in isolation, this is actually probably a good time to be a watch buyer. Now, you tell me what your experience is with availability, pricing, and discounts where you live. Leave it in the comments. And if you have a dream watch you're hoping to snag right now, which one is it? Let me know in the comments. Like, subscribe. Cheers.